Hello and welcome. After the events of 2020, are you financially on track for retirement and other long-term financial goals? In this webinar, OJM Director of Wealth Advisors, Bob Peelman, demonstrates a powerful tool that can help you answer this question. OJM Group partners are the authors of 12 books, including our newest books, Wealth Planning for the Modern Physician and Wealth Management Made Simple. To get your free print copy or ebook download, text OJM Web to 47177.
Thanks for joining us. My name is Bob Peelman. I'm the Director of Wealth Advisors here at OJM Group, as well as partner. And today we're going to be talking a little bit about some retirement planning tools that we have available, and I think are really important to discuss in a year like 2020, where we all realize it's been a challenging year. Many medical practices partially or fully shut down for weeks or months. There has been physicians impacted across the board within their financial plans, whether it be college education funding, retirement, charitable giving that you're used to doing. And I think it's important to have tools like this at your disposal and work with a professional to look at some of the ways that a year like 2020 could have impacted you and how you model that out and get back on track if you need to get back on track. So what I'd like to do today is take several minutes here to walk you through what is an actual client of our firm. Obviously, the names are changed and some of the situations within it are changed, but this is a real scenario. And not every client that we come across has both spouses working, both spouses with high income. Some are a little farther behind in their asset savings at different points. We talk to folks 5 to 10 years from retirement, early in their career. We help folks in retirement taking income. So this is just one scenario, but certainly there are a variety that we can model out that would fit your particular situation. So this is what we do day in and day out with clients. And this particular client, the very first thing we would do is talk to them about the very, very front dashboard here, which is the basic information, income, ages. You can see here, Jim and Sarah Smith, both physicians, both with high income in their late 40s. Jim is 47 years old, Sarah's 45. They would like to retire, both at age 60 for Jim. That happens in 2033. Sarah, a couple years later in 2035. We always model out a life expectancy of around 90 to 92. Some clients will have us shift that around depending on family medical history. And this particular client is looking for after-tax income of $250,000 a year in today's dollars. So why that's important is we spend a lot of time on the front end discussing expenses and what those might look like in retirement versus what they are today. We want to make sure that we do include inflation and make sure that the amount of money that we're talking about is going to be in today's dollars, and look at what total cost would be throughout your financial plan to fund things like medical issues, vacation homes, whatever situation you might have in retirement that you might not have today. We spend a lot of time talking about those situations. So once we get past this page, we're going to focus in on the first category, which would be what we would consider quote unquote guaranteed retirement income sources. Certainly doesn't mean that they're guaranteed, but it's more of an annuitized income stream is really the language that we try to talk about this income page. And what we put in is we'll get the Social Security income estimates for Jim and Sarah. And for them, they'd like to take it at age 67 and approximately $2,500 a month as their Social Security benefit for their life. We inflate that at about 1%. And in this particular situation, Jim has a cash value life insurance policy that he's been funding for several years, with the expectation that he will take distributions from this policy in retirement as a tax hedge, so that way he can take some tax-free income out of his life insurance when he needs to, potentially in years where the market's not performing well, and may want to tap into that cash value life insurance. So we have that modeled into this scenario. We spend some time on the balance sheet. And so this particular client, Jim and Sarah, have primary residence around $1.2 million, their vacation home at $500,000. These will be balance sheet items only in this particular scenario that we're running. Occasionally, we will hear from the client that wants us to model in a sale of a home in retirement or shortly after, and we'll show those proceeds coming into the portfolio and generating income. But for those that would like to keep the properties throughout retirement, they'll strictly be a balance sheet item. They have a joint investment account, and what they typically save here, they've got about $750,000. They're saving about $3,000 a month into this investment account. And this $3,000 a month is what they're doing after they're saving $57,000 a year into each of their 401k. So Jim has a 401k at the practice. Sarah has a 401k. Both are fully funding. They each have a smaller Roth IRA that they have been employing, a backdoor Roth strategy that we'll do with a lot of clients, which is if your income is too high to contribute to a traditional Roth IRA, then we'll open it and put those funds into a traditional IRA, and then immediately convert those after-tax dollars into a Roth IRA. So it's a way to get money into a Roth IRA very quickly, and a strategy that we've written articles on, which you can find on OJM's website, about the backdoor Roth strategy. But we're doing that here with this particular client. They have a practice surgery center and some equity in the practice that they will be selling when they retire. They're forced to sell. There's no choice to keep it. And so we model those in. We come down and look at their life insurance. They both have term insurance set to expire. They timed out the term to go specifically with their retirement, as their children will have aged past the point of having to take care of them if they were to pass away early and replace some income. And so we put in the life insurance. On the liability side of things, they do a great job here with their mortgage and their vacation home mortgages, both refinanced at very low interest rates, and they're very comfortable keeping these mortgages right now as is. Where we spend the vast majority of time is on this page, which can look like a lot of information, but I think it's one of the cleaner ways to look at retirement modeling. And what you're looking at here is, what would the balance of these assets be at retirement if they grow at around a 7% average rate of return? And in retirement, your assets growing at an average of 5. And we're not just taking a linear 777 interest rate or a 5. We're actually looking at real markets, and we'll model that out and say, here in a year, we may have a bear market where the market goes down 6, the next year 5, a couple good years, a really large correction year, some bull market runs, some down years. So we're looking at real markets, and it's 100 years of market history here, and standard deviations to get to this data. So very important when you're looking at a lot of online financial calculators that they're actually looking at real markets and real market volatility, because that will dramatically impact the success of your retirement plan. And in this particular situation, they've got about $6.7 million in retirement. They would like to have, as we talked about, that $250,000 of after-tax income. In today's dollars, that means that they really are going to need about $303,000 in the year 2033 to achieve that goal, because they're going to have to pay 40% in taxes. So we're going to take some of the sale proceeds that we have left over from the sale of the surgery center and the practice, as well as tap some of the dividends and interest from the investment account. We'll leave those retirement accounts to grow on a tax deferred basis, pay the $200,000 around in taxes. And again, we can limit that down with strategies, but we always try to be a little bit more conservative when we're modeling this. You'll see this income here at different checkpoints will continue to increase for their life expectancies all the way out to Sarah's age 92, with inflation continuing to take those distributions. And we're pretty comfortable when we have a financial plan that starts with 6.7, and for them, they have about 1.2 million in investable assets. They still have both properties. They still have their personal property and about $1.2 million of investable assets to pass on. Every client's different. Some want to leave a lot more. Some have a lot more charitable inclinations that they want to give. We have clients who want to take their retirement savings down as close as they can get it. And we can model those things in. So we can come down here and say, if you wanted to take more than $250,000 income, how much can you take? And we, come back. If you worked a little bit longer, if Jim wanted to practice out till 62 or 63, 64, how does this affect some of these ending numbers? And it can dramatically impact that. And so right now, heading into 2020, this is how it looked for this particular client. And one of the things that you might be thinking, and we're doing this, is these two physicians, elective surgeries stopped in the spring. Their income revenue at the practice has went down quite a bit this year. And they've had to pause and stop this $3,000 a month contribution. So the first scenario that they said to us was, run this scenario for us where we're no longer putting the $3,000 a month away. We're still fully funding our retirement. Everything else is the same. Our investments have bounced back and have exceeded this year's returns for where we were in the spring. So I don't really need you to model that in. But from an income cash flow wise, we need to rebuild what we're doing here, rebuild some of our emergency reserves that we used. So we're going to take off time on that contribution. And the first thing we notice is they're going to have about 6 million, and suddenly that cushion is gone at age 90. And we come over here and look at where they begin to have issues in their plan, and we can come down and see that right around for them age 89, 91, they begin to exhaust their reserves. Now, certainly investment returns could be higher, but they can also be lower through a period of time. So we're not comfortable at all when our clients have these types of plans. We really want to see that cushion, whether, whatever that number might be for you, 500,000, $1 million, but certainly not cutting it so close where you're running your assets down right to age 89 and 91 would not be what we would want to do. So we can model in, what do we want to see for this savings? So sometimes we could say, okay, well, I can't start that $3,000 a month right now. But I would expect in 2022, 2023, I'll be able to start that back up. Are we still okay if we do that? And in this particular situation, they are to a certain extent. They now can fully fund all the way out to 91, 92, but we still don't quite have that cushion that we want. And so we can come back and talk about, okay, if you took those couple of years off, can we make up for them in future years? And we'll add some income streams in there. If, the vast majority of our clients, and I'm just going to take this back to their normal scenario here. The vast majority of clients, if they had a properly structured investment plan and had good investment guidance, have went through the large correction in the spring that we've seen and have really rebounded nicely and are having a good year in their investments. But some may have gotten emotional and raised cash in the spring during the pandemic. Certainly a scary time for everyone. And if that was the case, then you'll notice, sometimes we'll come in and change the investment balances and say at the beginning of the year, we thought it was going to be this, but you sold all of your investments or sold the vast majority of them in the spring. And now you don't have 841, you have 7 or 650. And we can model that in. So this is a fantastic tool. I think this tool works for a variety of situations. It's not just retirement planning. We run it for education planning, saving for a vacation home. But I think it's a worthwhile exercise and tool to go through with your investment advisor. Certainly here at OJM, we would be happy to do that for you. If you'd like to see if you're on track for retirement specifically, you can request a complimentary review, and we would be happy to run through this scenario for you and your family to make sure that you're on track. Thank you for listening.
OJM is a multidisciplinary wealth management firm, and we have worked with over 1,500 physicians, businesses, and individual investors throughout the country. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. OJM partners have authored several books, all of which are available to webinar viewers at no charge. You can get a free print copy or ebook download by texting OJM Web to 47177. You can also visit ojmbookstore.com and enter OJM Web at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.